U.S. regulators are taking a closer look at whether computer trading needs more oversight as they continue to dissect the events surrounding the sudden market plunge on May 6th. Suzanne O'Halloran joins us now. She's joined by Tom Joyce, CEO of Knight Capital Group, the largest trader of U.S. shares. Suzanne?
Thanks very much, Julie. Tom, welcome to the program this afternoon.
Hey, thanks, Suzanne.
We want your take. We had the SEC and the CFTC weighing in on the causes of the flash crash on May 6th. A lot of issues came together. Give us your take. Did the report cover enough, in your opinion?
I think the report was exceptionally well done. It was based in fact. They spent a lot of time checking out all their sources of data, and I think they did a great job in terms of presenting it. You know, I think we learned several things that day. One is that macro events matter, and we were watching Greece implode live on TV, so that obviously put a pall over the markets. Secondly, it matters that market makers have rules of engagement, and I think we need to tighten up market-making rules. We also found out, obviously, that circuit breakers would help. So I think the CFTC and the SEC did the right thing pursuing circuit breakers.
Yeah, let's talk about the market makers, because today CFTC Chair Gary Gensler is asking if there needs to be tighter rules for those who engage in computer trading in terms of size and price limit. Do you want to see tighter rules? Is that going to hurt your business or help it?
Well, I think the disciplines around market making need to be injected in the market. In fact, we wrote a letter co-authored by a couple other firms to the SEC about 2 months ago, a month and a half ago, suggesting that market makers have more responsibility. They make tighter spreads, they're around the inside more often, you know, things like that, simple disciplines like that. So we definitely think things like that matter. I am also hesitant, however, to get too carried away with rulemaking. You know, one of the things we've seen was a lot of demonization almost of high-frequency trading and computerized trading when the report comes out and it turns out a traditional, very well-regarded mutual fund complex actually put the sell order in the market that catalyzed a few things. So I think we got to be careful about the rules that we want to promulgate for this market.
Tom, it's Julie here, but didn't high-frequency trading, even if though that first trade was sort of the trigger, there are still a lot, before and after the report, still a lot of folks who say that HFTs sort of exacerbated the selling on that day.
Well, I think two things had to be considered there. First of all, you saw that they were actually buyers. They were net buyers of the first wave of that sell program. So they were active on both sides of the market. But secondly, this is a market that was dominated by a macro news event. You can't discount the fact that buyers everywhere ran away from this market. You were watching Greece and Europe implode on TV. So you can't ever discount the fact that a macro event will dominate traders' activity.
Tom, we also had Senator Chuck Schumer saying, regardless of potentially what caused the flash crash, that there should be some regulation, even though folks like yourself say high-frequency trading and computer trading are cost favorable for investors in the long run. Are you afraid with the November elections coming up that your industry might actually get penalized for the events of May 6th, even though it was a group of events that caused it, including Greece?
Well, what we're counting on, and we've seen certainly the regulators rely on in the past, is that they continue to look at the data. It's easy to put out press releases and it's easy to say things in the heat of the battle. But when you rely on the data, you will find out that the electronic trading mode that most firms have adopted nowadays has added immeasurably to the quality of the market. I know of 3 independent studies that stated the same in the last 3 months. So all the data tells you that computerized trading is a fact of life and, on balance, a very favorable impact on our markets.
Tom, I also want to ask you, when we look at business, investors have been taking money out of the market since May 6th. Some say it's because of the big drop we had during the so-called flash crash. Can you give us an idea of how your volumes have been in the third quarter? BMO Trading came out with a report today and said volumes were weak. Do you agree with that? Is that accurate?
Well, volumes have been weak. They've been weak for several months. I think there was an article in the Wall Street Journal this morning that talked about it this morning as well. We've been saying for a while that volumes have been weak, that trading activity has been muted. I don't know if it's going to last a long time. Certainly there were seasonal pressures. I can assure you that if the market starts to pick up, activity will pick up.
Tom, just quickly here in about 30 seconds, if there is further regulation of high-frequency trading or further curbs put on market makers, what does that then do to volume?
Well, I think anytime you put a curb on the market, you run the risk of muting more volume. And that makes the markets more inefficient, and that raises the cost of capital to corporations nationwide. So you've got to be really careful about rulemaking in this environment. Let's look at the data and base any decisions we make on facts.
All right, Tom, we're out of time. Tom, Joyce of Knight Capital, and our Suzanne O'Halloran, thank you both so much.
Thank you.
Thanks, Julie.